Good morning, guys. So I just wanted to take a second to review the trade that we went over yesterday, just to give you guys an understanding of what it looks like when you break down the numbers. So you can do this on all of your trades. I just want to run through it real quick for you so you can see what this looks like in practice. So the trade we were looking at yesterday was this bull cash secured put right here at 1350. And I have a spreadsheet down here just so we can follow the numbers. All of the numbers that I'm going to be looking at here are taken straight from this options chain right here. So we can see the price of bull has not changed much from yesterday. We were here at around 1440. Today we're at 1450s, about a 10-cent change. So what we're looking at right here is we were looking at this 1350 strike, meaning we need $1,350 in our account to write this cash secured put. And the price right now is around this 1350 number. Our 300-day MA that we talked about yesterday, moving average is around $14.10. And the strike price, which is the price that we were saying we would purchase the stock at, 1350, is right here. Our mid premium, which is the amount of money we would collect for selling it, currently is about 70 cents, 71 cents. And you can see this has decreased from yesterday when that mid premium we sold was 79 cents. All this means is $79 because this is per 100 shares of stock. Our implied volatility number right here has shrunk a little bit to 149% when yesterday it was 153. And our open interest is still around the same, 7,497 contracts. And our expiration date yesterday was 8 days. Today it's 7 days. Our break-even price, which is the price of our strike minus our premium, is $12.71. What that means is that if we're assigned on this contract after this 8 days, in other words, the price is lower than $13.50, our break-even price, where we wouldn't make any money, just break even, is going to be $12.71. So we are buying this stock, if assigned, at a discount, which is great. That's the kind of stock you want to buy. You want to do this on stocks you want to own, and you want to buy them at a discount. If you don't get assigned on them at a discount, you collect a premium for selling them. So yesterday we had 8 days to expiration, DTE. In trades per year, all we're doing is saying we've got 365 days in a year. How many times can we do this in a year? So we can do this 45 times in a year. What you really want to pay attention to and what's super important is your premium yield here. Right now, you're probably getting 1%, 2% in the bank. On this one cash secured put, we're making almost 6% in 8 days. Now, this is not normal. It's not abnormal, but it's not what you're going to see every time you sell a cash secured put. This is a higher than normal return, but it's great because we just found it in when we were going through. However, the annualized return on this, let's say we were going to do this every 8 days throughout the year, is 267%. Where are you making 267% on your money? You're probably not. And it's a pretty easy way to get into the markets without too much risk, owning a stock that you want, an asset, and making a great return. So a great place to start. So this is just a real simple analysis of how one cash secured put can make you a little money to pay some bills for the week. If you have any questions, feel free to shoot me an email or just tag something in below. If you have any friends that you think will be interested in this content, feel free to send them a link, and happy to hear from you. Have a great day, guys, and I'll talk to you next week probably. Thanks. Bye.